Hey, what's going on, everyone? Today is September the 28th, 2022. We're going to talk about how Steve Hank is now saying that the U.S. has an 80% chance of a recession. Now, this is becoming like mundane, repeat of the mill, talking points, jargon about the U.S. economy hitting a recession, depression. Is everywhere you look. Everyone is talking about the recession. Everyone is talking about the depression. Everyone is talking about interest rates. Everyone is talking about the Federal Reserve. Everyone is talking about inflation. We get it. But guess what? There will still be opportunities to be had while price in the stock market goes down. We just got to be on the lookout to figure out where is the money going. So welcome to the channel. This is HueFin, also known as HueFin News. I drop these predictive price content for the stock market to give you all a heads up as to where I'm thinking the market's going to go in terms of particular sectors, the Dow, the NASDAQ, the S&P 500, even for single stocks. So if you guys want to join me, hit that like button, and also subscribe here to the channel. Now, Steve Hank, right? You guys can see him. Here he is right there. He's a professor. And he's trying to tell people on CNBC that the Fed has been looking at all the wrong places, trying to harness why inflation is going on. Now he made some very good points in the article, trying to say that the Fed is looking at everywhere else besides the money supply. Now I think many people forgot that during the pandemic, the Fed had that bazooka to where they printed trillions of dollars to try to keep the economy propped while it went through the pandemic, right? Now we are seeing the impact of that money printing. This is what Steve Hank is trying to say. And that currently some economists are saying that the recession chance is around 52%, right? You guys can see that CNBC's September Fed survey of economists, fund managers, and strategists survey said that there's a 52% chance the U.S. could enter into a recession over the next 12 months. Now, according to Steve, he thinks it's much higher than 50%. He thinks it's around 80%, maybe even higher than 80%. Now, you only got 20% before you hit 100% likelihood that the U.S. is going to hit a recession. 20%. You're only 20 points away from 100%. So he may be in the camp of saying, hey, yeah, I know we're going to hit a recession. Now, once the actual news media, social media picks up that we're in actual recession, it's going to be past the fact. A lot of people are feeling the brunt of this recession right now, of high inflation rates, mortgage rates going up, people can't buy houses, prices of goods and services are going up astronomically, and wages are not following suit. We're here. So as we go through this process of seeing a recession, we need to be prepared to figure out where to put the money. Where is the money going, right? So the probability of recession, I think, is more than 50%. I think it's around 80%, maybe even higher than 80%. This is what he told CNBC Street Science Asia on last Friday. Now, if they continue the quantitative tightening and move that growth rate and M2 money supply into negative territory, it will be severe. So if we keep going, he's trying to say if the Fed keeps going the way that they're going right now, it's going to be drastic. It's going to be worse than a recession. It's going to be bad. Now, quote right here from Steve Hank, they have really been searching for inflation and the causes of inflation in all the wrong places. They're looking at everything under the sun but the money supply. He's been critical in the past of the Fed's failure to manage inflation by keeping an eye on the large supply of money sloshing around in the U.S. economy. Now, the Fed is trying to say that money is not the issue. It's not the problem as to why inflation is going up. It has no relationship with economic activity. It's not a reliable relationship of economic activity and inflation. This is what the Fed is trying to place in the markets. They're trying to get people to think that way. When Steve Hank is saying it is, the more money you create, the more inflation you have to inflict to bring prices down because you got more of it already out in the market. So when you have more of something, then the cost of those goods, those services has to follow suit. That is why they're raising interest rates. But the Fed is not trying to tell people that. He blamed the U.S. central bank for rising inflation. The reason for that is because the Fed exploded the money supply starting early 2020 at an unprecedented rate, and they don't want this link to be visible between the money supply and inflation. That is the connecting point. That is the positive with the negative. You wanted to keep the economy from crashing during the pandemic, so you inflicted a whole lot of money into the market. Well, now you got to pay the piper. Now you got to pay up. This is what Steve is trying to say, but they're not trying to connect that. The Fed is not trying to put that out into the market. An increase in money supply drives up prices as consumers are willing to pay more for the goods. They got more money in their account. They got more money in their pocket. So they're willing to pay more for the goods. You take away the money, then people won't be able to buy. People will become a little bit more stringent on where the money goes. See? Classical economics, as put forward by Milton Friedman and others, have pointed to money supply as the culprit for out of control inflation. People already know about this. Milton Friedman has already established that money supply has a major impact on the economy, therefore impacts interest rates, therefore impacts the inflation. It's not like the United States economy hasn't been through a recession before. It's not like the U.S. economy hasn't been through a depression before. So why not act like the Fed is brand new at this? They have history to draw off of to see what they need to do. And I think they know what they need to do, but they don't want to do it. Especially right now, since the midterm election season is about to start up. They don't want to inflict a whole lot of negativity into the market to switch people's minds over into thinking, yeah, we might need to vote some people out. So they're going to try to keep this propped up for a little bit. Let's see if they can. You guys can see that this is how central banks control money supply. All right, this is from Investopedia. They have several different methods to increase or decrease the amount of money in the banking system. They're referred to as the monetary policy. All right, now here are a couple of ways. Central banks use several methods called monetary policy to increase or decrease the amount of money in the economy. The Fed can increase the money supply by lowering the reserve requirements for banks, which allows them to lend more money. Conversely, by raising the bank's reserve requirements, the Fed can decrease the size of the money supply. That's one way that they can actually reduce the amount of money that's in the market. They can also alter short-term interest rates by lowering or raising the discount rate that banks pay on short-term loans from the Fed. So they got a couple of things at their disposal that they can actually try to rein in the money supply. All right, so looking at the chart real quick in the S&P 500, you guys can already see I've done a price prediction for the Dow, which is right here. I did one for the NASDAQ and also for the S&P 500. So I'm not going to drop in another price prediction. Just simply you guys can see what my thought processes are. And as long as the market continues to trade below this downtrend line, yeah, we're going down. So right now, what we need to do is try to figure out where's the money going, because there will be some certain sectors, certain industries that's not going to be massively impacted as price continues to go down overall within the stock market. We need to figure out where those places are at. Let me know where you've been looking. What industry are you guys looking to think that the market won't be majorly impacted? In fact, it might even go up while stocks go down. That is where we need to be. So we need to be on the lookout for those things. All right, so go to my community tab. I've shown you a couple of stocks that hasn't been trending down. In fact, it's been going up in price. I know some of them has been the defense sector, insurance. A lot of that hasn't been impacted yet. So give me your thoughts. Make sure you maintain profitability, and as always, trade different.